Would you like to give more to charity without spending more cash? Well, donating appreciated stock that you've held for over a year can wipe out the capital gains tax that would have applied had you sold that stock, and actually you can get a deduction for the donation of that if you follow the rules. Today I'll show you how it works, the common pitfalls, and the step-by-step mechanics to make sure that you're doing it right. My name is Merrill Taylor. I'm a CPA. In my office here, in my firm, that we help high earners and business owners cut taxes proactively. This video is meant to be educational and not individual advice, so make sure you coordinate with your tax professional before you take any action. Now, the big idea here, the thing that we're talking about, is donating long-term appreciated securities, which can be individual stocks, ETFs, or mutual funds. Donating those directly to a qualified charity or a donor-advised fund, you generally will deduct the fair market value of those securities, and the charity receives the full value without anyone paying any capital gains on the embedded gain. To take the deduction, you need to itemize and stay within the AGI percentage limits. Now, what does long-term and fair market value mean? Those are tax terms that we use quite frequently, but can mean different things to different people. And so long-term means that you held the shares for over a year, for more than a year. If the holding period is 1 year or less, or the asset is what's called an ordinary income property, such as like inventory, then your deduction is limited to your basis, which is what you originally paid for it, and not the market value of that asset. So for publicly traded securities, the fair market value on the gift date is typically the average of the day's high and low. For mutual funds, you use the published daily quote. So as what you do there is you would actually look up the day that that stock was transferred to the charity. Let's say in case of a stock, you look up the date that it was transferred, you'd look at what the high was that day, the low was that day, you would average those, and that would be the fair market value of that stock for that day. So who can you give to? So make sure it's a qualified charity. Use the IRS search tool to verify eligibility before you make the transfer. So now let's talk limits, what kind of limits apply, because these limits tend to trip up people when they're given to charities. So cash gifts to public charities can be deductible up to 60% of your adjusted gross income. That's for cash. If you're to write a check, give cash directly to a charity. Long-term capital gain property, like appreciated stock given to public charities, is generally limited to 30% of your adjusted gross income, with a 5-year carry forward for any excess. So if your adjusted gross income for the year, say, was $100,000, your limit would be $30,000 in that case. If you were to give $50,000 of stock to charity, you would be $20,000 over. That $20,000 would carry forward for 5 years. Now, gifts to most private foundations are generally limited to 20% of your adjusted gross income, even when you can deduct qualified appreciated stock at fair market value. So the percentages vary by property type and recipient type, so you got to look at the planning to make sure that you're doing that correctly. Now, why donate stock instead of cash? Well, if you first sell the stock and then give cash, you trigger capital gain. If you just donate the shares directly, then the embedded gain in that stock is never taxed, and the charity can sell that asset tax-free. They don't have to recognize the gain. Nobody actually recognizes the gain. The gain just disappears. There's very few things in the tax law that can make gain disappear, and this is one of them. And that enables you to stretch both your giving and your tax deduction. So here's a simple step-by-step strategy to help execute a gift. Step 1, you want to get the charity's brokerage and wiring instructions, or contribute to a donor-advised fund if you want to bunch deductions this year and grant to charities over time. Step 2, mind the date of the gift. You want to pay attention to that. For electronic transfers, the gift date is when the shares arrive in the charity's account. For mailed certificates, the rules depend on proper mailing and receipt. Near the end of the year, transfers can take days or weeks, so you're going to want to keep that in mind and start the process early. Step 3, value the gift using the average of the high or low on the date that is given for the exchange traded shares. And then step 4, obtain a written acknowledgement from the charity and attach Form 8283 if your total non-cash gifts exceed $500 for the year. If the total of the property type exceeds $5,000, then some assets require a qualified appraisal, but publicly traded securities are generally exempt from the appraisal requirement, so you're going to want to keep the paperwork on that. So some quick numbers. Let's say that you bought shares for $10,000 and now they're worth $25,000. If you donate them after 1 year to a public charity, your charitable deduction is $25,000. It's subject to the 30% of AGI limit and carry forward rules. You also avoid the capital gains on that. So there was a $15,000 capital gain that was set in that. That capital gains basically just disappears. So you end up getting a double benefit in this case. You basically paid $10,000 for this stock. You got a $25,000 deduction, and you didn't have to recognize the gain for the $15,000 difference in between. So some smart tactics that you can use in this case. So first, donate winners, donate stocks that are in the money, that have appreciated, and you want to sell the losers, stocks that have lost money, because when you sell those, you can actually reap the losses from those, and you want the losses to benefit you on tax-wise, but you don't want the gains to hit your taxes. So for positions that are below your cost basis, it's usually better to sell, and it's called harvesting the loss in that sort of case. So you'd want to sell those and then just donate cash, because then you get the 60% write-off with the cash as well. Now, second, consider resetting your basis. So after donating appreciated shares, you can repurchase the same security with cash to keep your market exposure, but with a higher basis. The wash sale rule disallows losses, not gains. So this tactic doesn't trigger wash sale problems. Sometimes people will sell stocks that are in a loss position to harvest a loss, and then they'll rebuy this exact same stock. The IRS has rules called the wash sale rules that says, yeah, if you do that, it basically doesn't work. You don't get to take the loss. But it doesn't apply to things that are in a gain position. So you can basically donate those stocks to a charity and then repurchase the exact same stocks just to keep your portfolio balanced that way. All right, and then third, you want to look at bunching gifts with a donor-advised fund to maximize itemized deductions in a high-income year while granting to charities over time. Now, there are some special cases that you want to look out for. So with private foundations, deductions are more constrained, but gifts of qualified appreciated stock that's publicly traded can still be deducted at fair market value. Watch the stricter percentage limits. We kind of went over those. Sometimes it goes down to as low as 20%. Crypto is different. Digital assets are considered property, and for gifts over $5,000, a qualified appraisal is typically required. An exchange price alone isn't enough. And then for short-term holdings, less than 1 year, they're also limited to basis and not fair market value. So you're going to want to be looking for stocks that you've held a year or longer that has appreciated. Now, there's some common mistakes that we want to avoid in doing this. Donating to a non-qualified organization, initiating transfers too late in December, forgetting to file the Form 8283 with your personal return, or using the closing price instead of the average of the high and low. Those are audit magnets from the IRS. So make sure that you slow down things, document things, and then follow the instructions exactly. All right, some quick frequently asked questions just to kind of recap what we've done here. So first off, do you need an appraisal for public stock? The answer, no, not for publicly traded securities, though Form 8283 may still be required on the tax return. What if my deduction exceeds the limit? Well, you can carry the excess forward for up to 5 years. So you don't have to worry too much if you go over that limit. You just want to make sure in the next 5 years you'll be able to take that deduction. Can I give to a donor-advised fund and decide later which charities to support? Yes, you can get the deduction in the year you contribute to the donor-advised fund. How are the shares valued? You use the average of the high and low on the date of the gift. And when is the gift considered made? And it's when the charity's account is credited with the shares for electronic transfers, or mailed certificates follow mailing and receipt rules. So you want to start early in December in that case, just to be on the safe side. So what do you do next? So first you want to list appreciated positions held over a year, verify the charity status, and schedule the transfers with your broker well before the end of the year. And if you found this video useful, make sure you hit the like and subscribe button and share this with a friend who's charitably inclined. This may help them out immensely. And we'll bring you updates with the IRS as they come out on any of these strategies.